name is Julie Ramsey, and welcome to Part 1, Introduction to Insurance. Some key points in this session is that there are two kinds of risk. There's pure risk and speculative risk. There are three kinds of hazards, and for right now, a hazard is just something that makes it more dangerous. I want you to memorize the acronym STAR, S-T-A-R-R, and that will help you to remember ways of handling risk. We're also going to talk about adverse selection. And when you hear the word adverse, I just wanted you to think of bad. The insurance company does not want an adverse or a bad selection. And lastly, insurable interest. Why do you want to buy insurance? You have to prove that at time of application, and you must have the insured's written consent. Let's get into the details. What is insurance? Well, it's a contract that indemnifies against loss or liability from an unknown event. And it transfers the risk from the insured to the insurance company. You see, the insured pays a premium, and the insurance company then pays based upon the terms in that contract. Well, you might be asking, what is risk? Risk is the possibility that a loss might occur. And there are two types of risk. The first is pure risk, which means chance of loss only. And insurance companies will insure a pure risk. Or speculative risk involves the chance of loss or gain, like gambling or the stock market. Let's say that you and I make a trip and we decide to go gambling, right? We go to the riverboat and we call an insurance company and we say, hey, would you insure us just in case we lose money? The insurance company is going to say, no, you could lose money while you're gambling, but you could also gain. The insurance company will not insure a speculative risk. What is loss? Well, loss is an unintentional decline in or disappearance in value. What is exposure? Well, it presents a possibility of loss. It's what the insurance company could be liable. What is the insurance company exposure? What would they potentially have to pay? What is a peril? Well, a peril is the cause of loss, like fire, wind, lightning, whatever. Let's say that your house burns down to the ground. What's the peril? What's the cause of loss? Fire. What is indemnity? This is important because insurance restores the insured. It never makes you rich. It puts you back to where you were before the loss occurred. So indemnity means to restore or to make whole. What is a hazard? A hazard is a condition that increases the potential chance of loss or seriousness of the loss. Simply put, it makes it more dangerous. Now, there are three types of hazards I want you to be very familiar with. The first is a physical hazard. That means it's tangible. You can see it. Let's say that there's ice on the sidewalk, right? That makes it more dangerous. Someone is more apt to trip and fall. It's tangible. I can see it. It's physical. The next one is a moral hazard. Now, if you look at that word moral, I think of the things that I believe in, the things I should or should not be doing. There are some people who perhaps don't have the same morals that you and I have, and they're a hazard to the insurance company. So the definition of a moral hazard means that it arises from people's habits and values, perhaps like a drug addict. The last hazard is a morale hazard. And when I think of that word morale, I think of an attitude or state of mind. Maybe at your place of employment, all of the employees have a great morale. Yeah, it's great. I love to work here. Or it could be, man, it stinks. I hate to work here. But it's one's attitude. Well, a morale hazard arises out of human carelessness or irresponsibility where someone thinks, I don't care, that's why I bought insurance. I'm not going to lock my home, I'm not going to lock my cars, I'm not going to use smoke detectors. If anything happens, that's why I bought insurance, so I'm not going to protect my property. Law of large numbers. This is a really important concept. The law of large numbers. Notice it says large numbers, not small numbers. You see, in life insurance, there is an actuary department. They're like the mathematicians of life insurance. And what they do is they look at tons and tons and tons of people in the past, large groups, and they look at when they died. Okay? They look at mortality tables, the expected likelihood of death. And they have looked at so many people in the past that they are able to predict the future. And you may be saying, well, gosh, do they know exactly when I'm going to die? No, they don't know exactly who, but they have a very good number. And these numbers are so accurate that they can say at this age and this year, so many people will die. And how do they know this? Because they've studied so many people in the past that they're able to predict the future. And those numbers are right on. Managing risk. What is the dollar amount of potential risk? Well, it's determined by statistics of prior losses. So those statistics determine, should we insure it? Should we continue to offer this product? Methods of handling risk. Now, this is the acronym I told you about, STARR. I want to make sure that if I got a question that said, what are the ways to deal with risk, that I know all 5 of these. That S stands for sharing, pooling the risk. I'm not buying insurance, we'll just pool the risk. T stands for transfer. That means to buy insurance. How do we transfer the risk? It goes from the insured to the insurance company. A, avoidance. That means I'm going to avoid anything that's dangerous. R, retention. I want to retain some of the loss. We see this in health insurance where we have a deductible and we're retaining some of the loss. Reduction. I want to reduce the likelihood of loss. How do you reduce the likelihood of loss? By working out, by having smoke detectors, by wearing your seat belt. Those are ways to reduce the likelihood of loss. So methods of handling risk: STAR, sharing, transfer, avoidance, retention, and reduction. Elements of an insurable risk. I have another acronym for you. The loss must be, you can memorize CAN, HAM. C, calculable. Prior loss statistics are available. A, affordable. Your client will determine if that policy is affordable. N, non-catastrophic. That means to the insurance company. If we write this business, can we stay afloat? Can we pay our claims? H, homogeneous. That's a similar group of people, known as a class. A, accidental. It's not intentional. M, measurable in number and dollar amounts. Adverse selection. Now, I told you in the beginning of this session to always think of adverse as being bad. Well, adverse selection is this. It's the tendency for people with a greater than average exposure to buy insurance compared to everyone else. For example, if you live near an earthquake fault line, you would be more likely to buy earthquake insurance. In life insurance, unhealthy people have a tendency to buy insurance more than everyone else. The insurance company doesn't want a bad selection. They don't want an adverse selection. They want a good mix. What they want is they want some average individuals. They want some really healthy individuals. And maybe they'll take a few that are unhealthy. But they never want to be in a situation where they have unhealthy individuals buying insurance more than everybody else because they know that they're going to have claims. I want to talk about proving insurable interest. When you take a policy out on someone, you have to prove to the underwriters, why do you want this coverage? You have to prove insurable interest, all right? So you're simply answering the question, why do you want to buy insurance? Now, a person is presumed to have an insurable interest in his own life, a close blood relative, or a spouse. Why can you purchase insurance on those individuals or yourself? Because you're tied financially. You're tied emotionally. All right? Those are typically very easy to prove insurable interest. But what about when there's no emotional connection, but there's a financial connection? Like a business partner. Lots of business partners have life insurance on one another because if one business partner dies, how is the other one going to keep the business afloat? Insurable interest must be present at time of application only. Don't get confused. It's at time of app only. Later on, you can change ownership. You can change it to whomever you want, and you will not have to prove insurable interest. It only has to be proven when? At time of application. You must have the insured's written consent. You can't secretly write life insurance on someone and not tell them about it. Reinsurance. You know, you don't really hear of life insurance companies that can't pay their claims, do you? Think about it. One of those reasons is because of reinsurance. It's kind of like the insurance company's insurance company. Let's say an individual comes into my office and says, I want to purchase $1 million death benefit. All right, so I take an application, send it to our underwriters, and the underwriters say, well, gosh, $1 million, that's a lot of money. What they do is they'll go to this insurance company, this reinsurance company, and they'll say, hey, are you willing to take on some of this risk? Well, let's look at the application. They'll look at the application and they'll say, yeah, we'll take on some of the risk, sure. And then they'll go to another insurance company and they'll reinsure part of it, and another and another. So when the insured passes away, has a claim, the insurance company up here pays, but it's not detrimental to that insurance company. Why? Because they have spread that risk to reinsurance companies, and it's not detrimental to any one company. Some key points in this session. There's a lot of definitions. The highlights, though, is that there are two kinds of risk. There's pure risk, that's what an insurance company will insure, and speculative risk, which involves the chance of loss or gain. Insurance companies will not insure it. There are three kinds of hazards. Simply put, a hazard makes it more dangerous. There's physical, moral, and morale. Lastly, remember the acronym STAR, S-T-A-R-R, ways of handling risk. Two more I do want to include is adverse selection. Remember, an adverse selection means bad. The insurance company does not want a bad selection, they want a good mix. Lastly, insurable interest. Why do you want to buy insurance? When do you have to prove this? Only at time of application. No other time, just at time of app. And lastly, you must have the insured's written consent. Thanks for joining me today in part 1.